Hello, and thank you for joining me for this webinar today. My name is Tom Selby. I'm a senior analyst at AJ Bell. First of all, and most importantly, I hope you and your families are safe and well during this unprecedented period of lockdown. The impacts of COVID-19 are clearly wide-ranging, but this is first and foremost a health tragedy and a human tragedy, and all of our hearts go out to those who have lost loved ones during this incredibly difficult time. Today, as you can see from the title, I'm going to talk about one of those impacts of the COVID-19 outbreak, and specifically the consequences for financial markets and for people's pensions as well. But before I get into that, a few housekeeping points. So first of all, we will try to answer as many questions as possible, and thank you very much to those who have sent in questions. We've had lots and lots and lots. If people have more questions, they will receive an email after the webinar with an email address to send their questions to. An email will be sent out an hour after the webinar asking to fill out a feedback form and information on where to download today's slides. Please check your junk folder if you can't see it in your normal emails. The session is recorded and a video will be available on our website in the next week or so. And just the usual risk warnings. The value of your investments can go down as well as up, and you may get back less than you originally invested. We do not offer advice, so it's important you understand the risks. If you're unsure, please consult a suitably qualified financial advisor. Tax treatment, including tax relief, depends on your individual circumstances, and rules, of course, may change over time. So what we're going to talk about in this presentation. So 4 key bullet points here. We won't necessarily go in exactly this order, but hopefully it will make sense. So how COVID-19 and the coronavirus has affected people's pensions and how it might affect different types of pensions will be the first point. We'll then split into the 2 different stages that people who are saving and remaining invested may go through and that we'll need to consider during this period of crisis, namely the impact on people who are building up a retirement pot, and then moving on to the impact on people who have moved beyond that phase and are now drawing a retirement income or are looking to draw a retirement income. And throughout the presentation, I'll try to give you some key lessons and some hopefully helpful tips as you look to navigate this particularly difficult period of time. So first of all, how has COVID-19 affected different types of pensions? I think this is probably the question I've been asked most in the past 6 weeks or so. Of course, there are lots of different types of pensions and people in different circumstances within those pensions who are going to be affected in different ways. So no uniform measure of the impact of the current pandemic and a subsequent market sell-off on pensions, although we can see some of the impacts that we're seeing at the moment with different types of schemes. So if we split that up first into defined benefit schemes, so we've had the first official measure of where deficits have moved to, so the difference between the assets and the liabilities of defined benefit scheme. So we've seen the deficits have increased by around from around £11 billion at the start of 2020 to £136 billion at the end of March. So defined benefit schemes and then are feeling the financial squeeze at the moment, but members of those schemes need to take a breath and not panic at these figures. So a deficit figure is merely an accounting figure that schemes are required to publish in order to give a snapshot of their financial health at that point in time. But the most important thing for anyone who's a member of a DB scheme at the moment is to remember that the key thing that you need in order to be confident that you're going to get your pension over a period of time is a strong employer. And provided that employer remains in business throughout this period of time, and clearly there are stress on employers at the moment, then your DB pension should be safe. The best thing for anyone in a DB scheme is have an employer that's going to be around for years and years and years to keep on paying out your pension. But even in the worst circumstances with a defined benefit pension, and even with these deficits increasing as we've seen them do over this period of time, and we don't know what's going to happen into the future, there is a lifeboat scheme called the Pension Protection Fund in place to ensure that even if your employer does go bust, you should get back a decent chunk of your pension, even in the worst circumstances. So there are implications for defined benefit schemes. Members in defined benefit schemes will probably read some headlines which might look quite scary, but it's important to note both that this is just an accounting issue for a lot of defined benefit schemes, although these deficits will need to be paid off at some point in time. And even in the worst set of circumstances, there is a fund, the PPF, in place to ensure that you get something back. The next group of people who might be immediately, who may be worried that they will be immediately affected by this are those in receipt of the state pension. The good news is that there is no immediate impact on state pensions policy. So we've seen the state pension increase by 3.9% for the current financial year, so year 2020-21, meaning that the old state pension, so state pensions built up before 2016, the basic level is now £134.25. The new state pension, so the flat rate pension introduced in 2016, is now at £175.20 per week as things stand, because those pensions are provided by the government. Then provided that the government remains in business, then you should be fine to receive those payments. One thing that we have seen in the immediate political reaction to what's been going on around coronavirus are some calls for the triple lock. So this is the guarantee that the state pension will increase in line with the highest of average earnings, inflation, or 2.5%. There have been calls for that to be scaled back. However, we've had nothing from the government on that at this stage. Far too early, I think, to be having any of those kind of policy responses to the current crisis, and that will just be one for people to monitor. And finally, and this comes to the core of the presentation today, defined contribution pensions such as SIPs are where the really direct impact of the COVID-19 sell-off have been felt. The scale of the impact on people's pensions and people with DC pensions will of course depend on the mix of assets that you hold and where you are in your retirement savings journey. And if you are in those early stages of saving for retirement, then it's possible that a phenomenon called pound cost averaging could have helped and could help in future smooth out any bumps in the road in terms of investments. So looking at the impact on people who are in that saving phase of retirement, so the bottom impact of the COVID-19 sell-off has clearly been significant. Lots and lots of people now invested in pensions who have been affected by that. So roughly 10 million people have been automatically enrolled through their workplace into pension schemes. We've also got close to 1 million people investing in SIPs every year. As I say, the short-term impact of the recent downturn on your defined contribution pensions, so that includes self-invested personal pensions, will depend on the mix of assets you hold and whether you pay in regularly, so ideally once a month, or in a single larger chunks, perhaps once a year. So just to give you a rough example of where someone might have seen their fund go to between the start of 2020 and the middle of April. So someone who'd invested entirely in the FTSE 100 from the start of 2020 would have seen their fund value drop by over 22% on a total return basis by the middle of April. Those figures will have changed slightly since I did those sums, but many people looking at double-digit drops in the value of their retirement fund over this very difficult period. As I mentioned, depending on the mix of assets you have will influence how significant the drop has been for you. So those holding lower risk assets may have experienced shallower falls. It's important as we go through this period of volatility, this period where stock markets are quite unpredictable, to remember that volatility is part and parcel of the long-term investing process, and generally investors who have been patient and are willing to think long-term, and I'm talking about decades here rather than months tend to be rewarded by stock markets, but there are risks that you need to be aware of, and you need to be comfortable with the fact that over very short periods of time we will see fluctuations in the value of your fund. As I mentioned at the back end of the previous slide, by making regular contributions and taking advantage of what is known as pound cost averaging, you may be able to smooth out some of those stock market bumps. And so I thought it would be useful to look at how pound cost averaging has worked during previous crises. And luckily, we have a couple of quite recent crises that we can use to consider the impact of pound cost averaging. So while COVID-19 and its impact on society is unique in many ways, the impact it's had on stock markets, certainly over this short period we've seen, isn't unique. And so when I talk about pound cost averaging, what I mean is drip feeding your investments over time. So the idea is that if you do small investments each month, then you'll be able to ride out some of the fluctuations in stock markets a lot easier than someone who's having to try to time the market by, say, putting in one big investment at the start of the year. The best way to look at that is through an example. So if we look back to the dot-com crash, feels like a long time ago, probably because it was, back in 2001. So someone who had invested £12,000 in the FTSE 100 on the 1st of January 2001, so right just before the heart of the dot-com crash, would have seen the value of their fund plummet by £7,599 by the end of that year, so a fall of over a third in the value of their fund. If instead they had decided to drip feed their money over that period of time, so as the value of investments dropped, then their £1,000 would have bought a bit more and a bit more and a bit more over the course of that year, because the unit price of the funds they're buying would have fallen. Their fund would have been worth £9,824 at the same point in time. So still a fall in the value of their funds, but much less significant than if they had tried to time the market by doing one big investment at the start of the year. If we look back to the great financial crash in 2008, very similar results. So again, someone who invested £12,000 in the FTSE 100 at the start of 2008 would have experienced a 28% fall in the value of their fund by the end of that year. If the same person had drip fed their money £1,000 a month over the same period, then they would have still seen a fall, but it would have been half as much as if they put a lump sum in at the start of that difficult 12-month period. So in terms of what tips and lessons for investors to consider when they're saving for retirement, so some very simple things that you need to think about as we're going through this crisis. So first of all, the obvious one, and the one that I always say when I'm presenting to people, make the most of the free money on offer to you if you can afford it. Now, it's a difficult time for lots of people. There'll be people reviewing their budgets and facing employment uncertainty and potentially unemployment, who will have to really think very hard about where they can save and where they can invest and what money they need to make ends meet. But where you can afford to and where you have spare cash and your budget allows, make the most of the free money that's available. So that starts with the matched employer contributions available through automatic enrolment for those who are employed. Making the most of the pension tax relief boost that is available to you and the annual allowance that you have available each year. That's £40,000 for most people. And also, where appropriate, making the best of a fresh set of ISA and lifetime ISA allowances, as well as those pension allowances for 2020 and 21. The second thing that has become clear during this period of crisis is that lots of people aren't clear about the risks that they're taking and have been invested in funds that have been perhaps labelled in a certain way, which makes them believe that they're not going to lose money, or their losses are going to be limited to a certain number during periods of extreme stress, who've then been shocked at the amount their fund has gone down as a result of the COVID-19 market shock. So you need to understand what you're invested in and understand the risks you're taking as well. If you're approaching retirement and you're planning to buy an annuity or take your entire fund as cash, you should be reducing the investment risk you take as you approach that chosen retirement date. And you need to understand, if you're investing in a specific fund, you need to understand the risk that that fund is taking and whether or not there's any risk that your fund might drop in value just as you approach the point when you want to take your money. Generally, people want to have more certainty of what the value of their fund is as they approach that chosen point in time. And I've seen examples of funds from various different companies that said that they were aiming at annuity purchase, but when you looked at the performance in the initial weeks post the coronavirus sell-off really taking hold, you saw that those funds were dropping in value by 10, 15, even 20%, leaving people potentially having to make quite difficult decisions about when they're going to retire as a result. And the third point, and the one that we covered off I think most in that section of the presentation, if you want to mitigate market timing risk, and frankly trying to time markets during periods where things feel relatively normal and buoyant can be a fool's game. And so trying to time markets during an unprecedented global pandemic and lockdown, in a period when it's not clear when that lockdown is going to be lifted, is going to be nigh on impossible. And so rather than try to do that, it can be easier both from a behavioural perspective in terms of trying to build up a savings habit, but also in terms of trying to avoid second guessing what is going to happen to the market, to drip feed your investments on a regular basis so that you are avoiding that market timing risk. Now, that first part of the presentation has focused on people who are saving for retirement, although there are some principles there that can be applied across the investing spectrum. I'm now going to turn to the impact that COVID-19 has had on people taking a retirement income through drawdown. And this, if you're taking money out of your pension while staying invested, there are different and potentially more pressing challenges that you need to consider. So if you're in the savings phase, you're building up a pension and you potentially have decades before you're going to touch it, then it's likely that you're going to be more able to ride out some of the short-term ructions. However, if you're at the point where you're taking an income from your pension, then it's more likely that you will need to review what you're doing and make sure that your withdrawal plan and your investment strategy remains both appropriate and sustainable for the long term. So in these next few slides, I'm going to look at both the investment impact and what you need to consider if you're withdrawing money while staying invested, and also some of the considerations that people need to think about as they enter income drawdown for the first time during this difficult period of time. So looking at the withdrawal investment angle, so one of the key things that we've been talking about for a number of years is the risk of what's called pound cost ravaging. So this is, in a sense, this is the opposite end of the spectrum to pound cost averaging. So where pound cost averaging allows you to smooth out returns during the savings phase by drip feeding your contributions into your pension over the course of a year, say monthly. Pound cost ravaging works in the opposite direction. So if you're taking significant income withdrawals and your fund suffers large falls, particularly during the early years of drawdown, then the risks that you'll place in terms of potentially running out of money in retirement will be significant. So again, often easiest to explain concepts like this through an example. So Paul is 65 years old and retired in April 2019. After taking his tax-free cash, Paul was left with a fund worth £100,000. He's decided that he needs £5,000 a year to support his lifestyle in retirement and wants to keep his spending in line with inflation. So he'll be taking £5,000 a year, increasing by 2%, in line with what the Bank of England has previously said it expects inflation to be. So 5% of his initial fund value he'll be taking as an income each year. After making his initial 5% withdrawal, his fund was hit by the COVID-19 sell-off, reducing the value at the end of year 1 to just £72,000. Now, it's difficult to know where we're going to go to from here, but if we assume that having made that initial 5% withdrawal, Paul continues as planned, so continues to withdraw £5,000 in 2019 prices over the course of his retirement, and enjoys 4% returns post charges over the rest of that period, his fund will run out after 18 years. So to give you a bit of context, in that 18 years might sound like a reasonable period of time. The average life expectancy for a man at 65 is 18.6 years, and for a woman at 65 is 21 years. So there's a chance that that approach will be okay for Paul, for him to continue taking £5,000 a year from his £100,000 initial fund. But a man has a 1 in 4 chance of living another 27 years, while a woman has a 1 in 4 chance of living another 29 years. So while in some circumstances taking that money might be okay, and it might just about work out, for most people, a 1 in 4 chance of outliving their pot by the best part of a decade would be too much risk to consider. Now, looking back and going to the final bullet point here in terms of the impact of pound cost ravaging, so we've seen there that Paul, because he's had a very difficult first year of his drawdown phase, his pot has run out after 18 years. If everything else had stayed the same and his difficult year had come in year 10 instead of year 1, then so the 20% fall in his fund has come in year 10 instead of year 1, then his fund would have lasted an extra 3 years longer. So key thing to think here is that if you're in the early years of drawdown and you experience a significant fall in the value of your fund, then ploughing on regardless may leave you at risk of struggling to make your fund last longer throughout the course of your retirement. So when you're accessing your pension pot for the first time, there are various pitfalls and bear traps that you need to be aware of. So we've looked at the impact that COVID-19 will have on people's investments and the potential risk of significant negative performance in the value of people's funds being coupled with large withdrawals could have on the sustainability of their retirement plans. But there are also some tax issues that need to be considered for those who are accessing their pension for the first time. The graph to the right hand side of this slide just shows you the total value of pension freedoms withdrawals each year. So that's our analysis of HMRC quarterly data. And what you'll see, unsurprisingly, is that in the first quarter of the financial year, so April to July of every single year, the pension freedoms has seen the largest volume of withdrawals. Now, we don't know yet what the impact of coronavirus will be on people's behaviour in terms of withdrawing money from their pensions. So there will be some people, I suspect, who will decide to put off making withdrawals from their pension, perhaps because they want to avoid selling down investments at what is clearly a depressed point in the market cycle. Equally, there will be people who are facing financial strain, who are perhaps struggling to make ends meet, who will now decide that they need to take money from their pension perhaps earlier than they planned to, in order to pay the bills and feed their families and generally make ends meet. If you are thinking of accessing your pension retirement pot for the first time, it's important that you understand the consequences, have a plan in place, and crucially, stay engaged with your retirement planning. So in terms of the things that you need to know about, so first of all, if you access taxable income from your pension for the first time, you'll trigger the money purchase annual allowance. So this will permanently reduce your annual allowance from £40,000 for most people to just £4,000. Not only will you see your annual allowance reduced by £36,000 in most cases, but anyone who triggers the MPAA will lose the ability to carry forward unused annual allowances from up to 3 previous tax years. So someone with UK relevant earnings of £160,000 who had 3 years of carry forward available could theoretically pay £160,000 into a pension in the current tax year, using those 3 times £40,000 annual allowances plus the current year's £40,000 allowance. If they triggered the MPAA, they would lose the ability to carry forward all of those 3 years allowances, and their allowance for the current tax year would be reduced by £36,000. So effectively, their annual allowance for the current tax year could be down by a whopping £156,000. Now, that's not a reason to not access your pension if you really need it, but if you're taking taxable income from your pension, you need to be aware that you're going to trigger the MPAA, and it's going to drastically reduce the amount that you can save in a pension for the rest of your life. Second thing to be aware of, the taxation of your first flexible withdrawal in the tax year. So since April 2015, over £500 million has been repaid to savers who are overtaxed on their pension freedoms withdrawals. This is because HMRC will automatically tells providers to apply what's known as a month one emergency tax code to the first withdrawal of a tax year, which means that the usual tax allowances are divided by 12 and then applied to that first withdrawal. So again, if you look at the third bullet point down here, we have a worked example of the kind of tax charges someone might experience. So someone with no other taxable income who made a £12,500 withdrawal in 2020-21, so in line with the personal allowance, they might expect to pay no tax over the course of the year, but because month one is applied, and because rather than having the usual gamut of tax allowances, each band of tax allowances is divided by 12, then applied to that withdrawal, he ends up with an initial tax bill of nearly £4,000. Now, that is a pain, but luckily, there are simple ways to get your money back, as you see in the final bullet points down at the bottom of the slide here. So Paul will need to fill out the official reclaim form, the relevant one, depending on what he's done with his pension pot. You can see via the link there. If he does that, then HMRC should refund him in full within 30 days. However, if you don't go down that route, then it's likely you'll either need to wait until the end of the tax year to get your money back, or you'll need to rely on HMRC to sort things out for you, which is a position most people don't want to be left in. Crucial thing to remember here is that the overtaxation problem primarily relates to people who just make the one withdrawal, either an ad hoc withdrawal or a single drawdown withdrawal in the tax year. If you take a regular stream of income, then HMRC should put you in the right position, adjust your tax code, and you should be automatically put into the right position financially. But if you don't take a regular income, you just take the one withdrawal in a tax year, then it's likely you'll be overtaxed, and you'll need to go to that website, so www.gov.uk/claim tax refund, in order to get your money back. The next key point is around people who are just taking their tax-free cash. So the FCA the regulator for city firms did a very thorough piece of research on the behaviours of people in retirement, and most people understandably cite accessing their 25% tax-free cash as the main reason for entering drawdown. The reason for this clearly is that it's one of the big incentives for saving for retirement, and one of the primary reasons that lots and lots of people save in a pension. Now, accessing your pension's tax-free cash doesn't necessarily mean that your underlying investments need to change, particularly if you're going to stay in drawdown. If you're, say, reaching 60 or 65, then you might have another 10, 20, 30-year time horizon. So it doesn't necessarily necessitate a change in the way that you're investing, but it's worth using this as a point in time just to review your retirement plans and your ultimate goals and the way that your money is being invested. So as an obvious example, someone who is taking a regular income after accessing their tax-free cash will likely have a very, very different tolerance to risk and will choose different investments to someone who doesn't plan to touch their money for 15 years or more. Equally, someone who's planning to buy an annuity within the next 5 years or next 2-3 years will have a very, very different risk profile and will want to choose different investments to someone who's planning to stay in drawdown for 20 or 30 years. So the key is to think about your retirement goal and the risks that you're happy to take in order to reach that goal. And some of the key questions that you need to ask. So do you plan to take a retirement income in the coming years or use other assets instead? Is your priority to leave money to loved ones? If so, your pension might be the last asset you want to touch. That's because pensions can be passed on tax-free if you die before age 75 or at your recipient's marginal rate. If you die after age 75, so pensions are, from an inheritance tax perspective, incredibly tax efficient, and so that's something that you'll need to consider. As I mentioned at the start, you need to understand that your investments can go down as well as up, particularly over the short term. Equally, on the other side of the risk spectrum, if you just have all your money in cash over the long term, then the value of that money will be eaten away by inflation. So it's a case of balancing up your appetite to risk, what you want to get at the end of your retirement journey, and understanding that if you take no investment risk whatsoever and just have your money in cash, then the real value of that money will be reduced over the long term. So we looked in the middle of this presentation at some of the tips and lessons for people who are saving for retirement. In terms of people who are taking an income in retirement, so some things to consider. If you plan to carry on saving, be aware of the MPAA. Now, this is unavoidable if you do take taxable income from your fund, but if you just take your 25% tax-free cash or you access other cash savings, then you'll be able to retain your previous annual allowance, which, as I said, is usually £40,000 for most people. Beware of pound cost ravaging. So if you're hit with big investment losses, particularly in the early years of drawdown, you might need to reduce your withdrawals in the future. And the key thing is to make sure you don't just stick your head in the sand and assume everything's going to be okay and assume that markets are going to return you to where you were previously. Particularly if you suffer big double-digit falls in the early years of drawdown, it's going to be really difficult for you to continue on a path that you're on. If you're taking withdrawals of 5, 6, 7% of the value of your fund every year, then in all likelihood, you'll run out of money early in retirement if you go down that path. There are strategies in place that you can use to try to mitigate the impact of pound cost ravaging. So accessing other cash assets first is a good way to go if you have that option. Equally, living off dividends. The dividends your underlying investment produce means that you won't sell the underlying capital, although of course that's going to be quite tricky at the moment because lots and lots of companies have stopped paying dividends in the current financial year due to the strains that they're feeling because of coronavirus. And finally, and I think in a way the simplest and most important thing here, make sure you have a plan. So think about your retirement goal, how you want to achieve it, and the risks that you are comfortable taking. Just as when you're saving for retirement, as you move into the phase where you're taking an income in retirement, set a budget and make sure that you try to stick to it where possible. And as I said earlier, if you're planning to leave money to loved ones after you die, consider drawing on your non-pension assets first, which might be subject to inheritance tax in a way that pensions usually in drawdown are not. Thank you very much for listening. I hope all the sound and things worked okay on that. Clearly, we are operating in interesting times in terms of carrying out a webinar. Once again, thank you very much for all the questions you sent in, some terrific questions and a huge volume of questions as well. Now, I'm not going to be able to get through all of them, but if you have any questions on the presentation or anything I've said, or if you feel that the question you sent through hasn't been covered off, then please do feel free to email me directly. My email address is tom.selby@ajbell.co.uk. That's tom.selby@ajbell.co.uk. But I'll pick up on the questions that have been sent through and then we'll see how we go. So the first question, just before the COVID-19 pandemic, I transferred my SIPP to AJ Bell. Fortunately, the investments were turned into cash just before the pandemic, so I didn't take a big hit.
I now have money sitting in a cash account and I have no idea what to invest in. In what should I invest it given the current situation? I'm 60 this year, still working and not planning on retiring until I'm 65 and maybe beyond. I don't want to take any big risks with my SIP pot, and I'm looking to protect it as much as possible. So before I kick off with answering these questions, I think it's worth reiterating the point that whatever I say here is guidance and not advice, and so it should be construed as such. If you want advice, then you should go and speak to a regulated financial advisor who will charge you a certain portion in order to receive that advice. However, I can provide some general pointers. So, as I hope I covered off towards the throughout the presentation, the key thing that you need to think about here are the risks that you're comfortable taking, your budget in retirement, and the time horizon over which you're looking to take those risks. So if somebody wants no risk in retirement whatsoever and no risk in their fund whatsoever, the only asset that will ensure that you have no risk will be holding money in cash during the savings phase, and the only way to ensure that you're not exposed to investment risk in retirement is to buy an annuity. So for somebody who wants no risk in retirement, an annuity is likely to be the likely option. If you're going to go down the route of annuitization, so somebody who is generally a low risk or no risk investor who just wants to maintain the value of their capital, then it's going to be important to think about what you're doing with your investments as you approach the date that you're going to convert your money into that steady stream of income. As I mentioned during my presentation, I've seen examples of people who invested in funds which were invested in money market instruments, so not in actual cash, but in things like gilts, who clearly thought that their money was going to be safe and would never go down in value, who experienced double-digit falls in the value of their funds just as they were approaching the point where they wanted to convert it into a steady stream of income in retirement. So it's crucially important that you understand where your money is going to be invested and how potentially it could fluctuate over time. If you do decide that you want to take some, if you don't want to lock up your money in an annuity and you want to keep some risk on the table, then there are investment funds that attempt to focus on capital preservation, so things like absolute return funds, although we have seen over this current period of time that the performance of those types of funds and all other types of funds during this period of stress have been severely tested, and some have been found wanting and have not been able to continue giving you that stable level of return. So if someone is aiming at annuity purchase, then it's important to make sure as little risk is on the table as you approach that point of buying an annuity, and that you understand that if you're in funds and you're even in things like money market funds, then there's a risk that your pot will go down in value. And it's important, if you go into the point where you're taking income from your fund, if you're in drawdown, there will be some investment risk. If you want to go down the annuity route, that's fine, but you will be locked into that income for the rest of your life. So on to the second question. This was a question I think that was in three parts. A third part I think I'd already answered in the presentation, so I'll just pick up the first two. Can I pay into a SIP based on buy-to-let rental income only and still get tax relief if I do not have any other earned income? So in the presentation we touched on the different allowances that are available. So if I briefly go through those, so there's a main annual allowance that's available to most people of £40,000. There's then two different versions. So the money purchase annual allowance, which I mentioned for those who access taxable income from their fund, which reduces that annual allowance from £40,000 to £4,000. There's also a tapered annual allowance for very high earners, which sees the annual allowance gradually reduced to a minimum of £4,000. That's for people who are earning upwards of £300,000. But your annual allowance each year is also impacted by what's called your relevant UK earnings, which is what's being referred to in this first question. So you can only pay in up to 100% of what HMRC deems relevant UK earnings in any given tax year. So that relevant UK earnings covers a multitude of things, including salary, bonuses, overtime, things like that. It does not cover dividends, it does not cover investment income, and it does not cover rental income either. So if you've got buy-to-let property, then the income that you receive from that buy-to-let property will not count towards your UK relevant earnings. However, if you have no UK relevant earnings whatsoever, you can still pay up to £3,600 a year in total into a pension. So you can still save some money tax efficiently even if you don't have any UK relevant earnings. It's also worth, I think, considering other tax efficient vehicles, given that your ability to save in a pension will be restricted. So looking at things like ISAs as well to shelter as much money as possible from the taxman. The second part of that question, what happens to my SIP funds if I pass away? So it's a question around how SIP money can be passed on to children. Again, something I touched on briefly in the presentation. So if you die before age 75, then you can usually pass on any undrawn funds in a SIP tax-free to your loved ones. If you die after age 75, the money that you leave behind will be taxed at your nominated beneficiary's marginal rate of income tax when they come to draw the money. A couple of key things to remember here. So firstly, if your priority is leaving money to loved ones, then you need to make sure you've made your nominations and kept your nominations up to date. So nominations being the people who you want to receive your money when you're no longer here. Clearly your life circumstances can change in various different ways, whether it's having children or remarrying or having deaths in the family. There'll be various different things that can happen that will mean your nominations need to change to reflect the people who you now want to see receive your pension. So keep on top of your nominations. And also a planning point for those who are going to receive the pension. It's important that the money needs to be designated. That means just transferred into the beneficiaries' names within 2 years of the person who's passing the money on dying, in order for the money to be tax-free. So our next question, we had a couple of questions around this point actually. I have a defined contribution pension valued at £55,000 with my current provider. Do I need to take advice before transferring? The answer is simply no. So there is an advice requirement in place on pension transfers, but that relates only to transfers from defined benefit schemes to defined contribution schemes. So those are the types of pension schemes that I mentioned right at the start of the presentation, where it's an employer who stands behind the guaranteed pension that will be paid out to you, that takes on all the investment risk. If you're wanting to give up your rights to a defined benefit pension worth £30,000 or more and move it into a defined contribution pension like a SIP, so there's a £30,000. If that DB pension is valued at £30,000 or more and you want to move it into a SIP, then you will need to take regulated financial advice before you make that transfer. Now, while you need to take advice, there's no requirement that you follow that advice or that advice results in a positive recommendation. However, a couple of things to note. Firstly, it can be quite difficult if you're looking for DB transfer advice to find an advisor who will take on your business for various regulatory and economic reasons for those advisors. So I've spoken to many people who've had to go through 10 or more different financial advisors to find someone who's willing to speak to them. And secondly, during this particular period at the moment, the pensions regulator has said that companies with defined benefit schemes are allowed to suspend processing transfers to defined contribution schemes for a period of 3 months. So if you're in a defined contribution scheme, the advice requirement doesn't apply to you. If you're in a defined benefit scheme and looking to go through a transfer at the moment, then it's possible that you'll experience delays to that process. So that's just something that some people will need to think about if they're considering moving from a defined benefit to a defined contribution scheme. So the next question is from somebody who is semi-retired and on furlough. They've taken the tax-free cash and they've been taking £2,000 a month as pension. Cash assets have now run out and I need to convert some of my investments into cash. Given the circumstances, what is the best strategy? So we had a number of questions in and around this point. I think clearly, understandably, there are some nerves from people around selling down their investments at what could be a trough in terms of the value of those investments. I think while I can't specifically give you any tips as to whether or not selling your investments now is a good or bad idea, if you want to avoid selling those investments, then as I've mentioned in an earlier one of those slides, you should consider looking at other cash assets you may have. So whether you've got ISAs or money in a bank account. It's also, and it sounds simple, but people often forget this. It's also worth just sitting down and going through your day-to-day spending. So if you've been taking out a certain amount of money pre-COVID-19 to fund your lifestyle, you may think that that's the amount of money that you're going to continue to need. But if your priority, if you're really, really worried about selling down lots of investments at a time when clearly market uncertainty is rife, then just sit down and go through your budgets and think about any of the things that you spend money on that perhaps you could not spend money on today. Now, it may be that just means that you can reduce the amount that you take from your pension at this point in time, or it may not. Clearly, there will be some people who are struggling to make ends meet, who just have no spare money and have no option but to access their pension and access taxable income from their pension. But it's worth just sitting down and going through that exercise to make sure that you aren't selling down your investments at what might be a low point in the market when there are other avenues that you could go down. So the next question, what is the risk of holding more than £85,000 with one SIPP provider? Okay, so I think this question relates to the Financial Services Compensation Scheme protection limit. So for savings and investment, the Financial Services Compensation Scheme exists as a lifeboat to ensure that if a financial institution goes bust, that you will get some of your money back up to a limit of £85,000. So the key thing to remember with the FSCS limit is that the £85,000 relates to each financial institution. So the key thing to remember is that you're not necessarily looking at the SIPP, although clearly the financial strength and well-being of your SIPP is important. The key is where your money is ultimately invested, so who is ultimately holding those assets. So if you're investing via a platform, most people will have their money in different funds or in different different FCA regulated funds, and so you need to look at the financial strength of those funds that you're invested in, and also consider whether your money's spread out between different investment funds as well. If your money's held in cash, then again you should speak to your SIPP provider about who they do their banking with, because your SIPP money, any money held in cash within a SIPP provider will likely be held with an external bank account, and so it's the financial strength of that bank account that will and whether or not that bank is able to remain operating in the future, which will determine your eligibility or otherwise for FSCS protection up to £85,000. Regardless of the FSCS limits, it's sensible to do a reasonable amount of due diligence, just like you would with your investments, on the financial strength of the company that's going to be administering your investments, and also where that money is ultimately going to be invested. Even when people are entering drawdown retirement, we're talking about periods of decades rather than 2, 3, 5 years. And the last thing anyone wants is for their money to be held by some fly-by-night company that isn't necessarily going to be around as long as they plan to be around for and isn't going to be there to ensure that you can access your money throughout your retirement. And so the final point I wanted to pick up on, there were like lots and lots of questions, and I thank you for them. There were a lot of questions around attempting to time the market, asking for suggestions on what specifically should be bought and sold during this period, and I think generally looking to take advantage of or attempting to take advantage of what is clearly a stressed time for financial markets. I would say to all these people, clearly I can't give specific recommendations or advice, and frankly during this time I wouldn't want to, even to my closest family. It's so difficult, and generally attempting to time the market is very, very difficult, and I would say it's nigh on impossible at the moment. So what I would say to you, if you're trying to go through a process of timing the market or you're looking for tips, stick to the basics. Make sure you've got the basics right before you're trying to do anything too clever. So invest in a way that you are comfortable, taking risks that you're comfortable with, and considering your investment time horizon. Be prepared for when things might get tough. So it's often suggested that people hold at least 6 months of money in cash in terms of their savings, so that if they lose their job, then they're able to at least cover the bills and all the rest of it. For some people, it may be this current crisis may make them think of reassessing how much money they want to hold in cash, and may make people want to hold more money in cash in order to prepare for a rainy day. Stay engaged and be prepared to adjust your plans if circumstances change. That's something that we covered off in the section on pound cost ravaging. So don't just stick your head in the sand, particularly if you're taking income from your retirement pot, because you will be risking retirement ruin if you just keep on taking large withdrawals after you've suffered a hit to your fund. Do your research and only invest in things you understand. A very simple point, but something that people often forget. And finally, again, I can see the temptation to look to try to either recover some of the value that you may have lost or feel that you've lost over the short term, or try to second guess what markets are doing. You just need to be aware of the risks of going down this route. So if you trade lots, then you're going to be layering on costs in an uncertain time and with no guarantee that you're going to get any better returns. And there's a risk if you start doing lots and lots of trading that you'll drift away from your ultimate risk tolerance and your long-term strategy. So rather than focusing on asking people what should I do and looking for very specific ideas, it's good planning to stay focused and think about these simple, broader things that you can do to ride out what is quite a stormy period for everyone. Okay, that's covered off all of the questions that I think weren't already covered off by the slides that I'd already done. If, as I said just before I started going through this question section, if you feel that your question hasn't been covered, or there's anything within the presentation that wasn't clear, or you have any questions on, please don't hesitate to drop me an email. My email address is tom.selby@ajbell.co.uk. And with that, I'll just say thank you very much for listening. Stay safe, look after yourselves. We'll be here to provide information and updates as regularly as we possibly can, so you can stay informed and as calm as possible during what is clearly a very turbulent time. Thank you very much. Goodbye.